have this morning.
Nice.
So good morning. This is Carl Dakin, and it's the day before Christmas or Christmas Eve. This is the Successful Funding Show. And for those of you not familiar with me, I act as a coach, helping small businesses and communities design, stage, and conduct their capital campaigns to raise funding. And this show is part of my multi-tiered efforts to share information that I've learned over 45 years in raising funding. Other things that are up for free, you can get my instant funding newsletter, now published Monday through Friday on LinkedIn. We have this show, which is put on Tuesday mornings, every Tuesday morning at 8 o'clock Mountain, 10 o'clock Eastern. Then I have my AI avatar on my website, which I'll give you a link to here in a moment, Cap, who can answer your questions 24/7. And some days I know he does a better job than I do, but since he's free, you get what you pay for. And last but not least, if you have a question, I'm available for a 15-minute phone call without charge. It does have to be scheduled. I can't take them on the fly. My calendar is a little too awkward and full for that, but happy to try to point you in the right direction. Now, if all these things fail and you need more detail than that, there are a couple options. One, I'm going to be doing a workshop, which will be on the topic of raising funding using my approach. It's going to be on January 16th. Now, this is 4 hours of intense, who are you, who cares, who wants to give you money, how do you find them, how do you craft an offer for them, and how does that lead to the planning and implementation of your campaign. So there's all kinds of information about that on my website, which you can see here. The retail price for this workshop is $500, but you as a viewer, you get a discount if you use the discount code that's on the screen. So there's an early Christmas bonus, but this discount is only good till the end of the year, which we are now 7 days away. So please take advantage of that if you'd like to attend the workshop. Then the other thing is if you need truly custom assistance, then that's me available as a consultant. I do charge fees for my consultancy when we get down to one-on-one help and assistance. I've worked with all kinds of organizations across the United States and a couple international, and happy to see if my experience, my skill set can be of help to you. And if it can, let's work out a deal and let's get to work. So with that, today, it being the holiday, I decided that we should talk about contrarian funding. This is funding that doesn't follow traditional classical lines. It's funding that may work when traditional classical lines will not work, cannot work. And to help me in this discussion, I've invited my good friend, Eric Hanson, who I will say we have a lot of similarities in having too much experience with things that don't work and should work, but somehow they don't get done. And so we're going to talk about these today. We're going to maybe stick a pin in a lot of the myths and fables and misconceptions about the capital industry, and hope to have a good time. And we're going to cut out early because one of my good old friends invited me to start celebrating Christmas early. And I'm going to take him up on that offer. So we'll quit about 5 minutes before the hour. But thanks to all the people in the audience. Thank you for being here. And I see that Don is already here this morning. Don, good morning. Don is my mentor who has helped me learn everything I've learned about LinkedIn and LinkedIn live streaming. And I appreciate all of his help in getting me to a point where I can put on this show and assist my clients in putting on their shows. So thank you, Don. Thanks for being with us this morning. So Eric, now that we're down to the brass tacks of talking about those rare moments when funding cannot be raised, What do you see as being one of the best things that an entrepreneur, anyone looking to raise money, can do that maybe isn't crafted out of the classical traditional lines?
So when you're talking about contrarian funding or contrarian mind thought, typically, or that was born out of the financial world to begin with. And more specifically, it was a thought process. I believe it was back in the early 70s, maybe late 70s. There was a group of guys who wrote several books about the stock market. So that's kind of where it started. And of course, since then, there's all kinds of indexes now that predict whether or not it's oversold or overbought. And that's a very contrarian idea. So that's where it kind of came from, and it's very successful. So in the financial world, when you're looking for money, the normal folks are going to go to a bank, or they're going to go to maybe a friends and family, or maybe even to if they have a big enough project, venture capital, right? But there's a place out there that really is very contrarian, and it's not well known. At least I don't think it's well known. Maybe, Carl, it is to you. But the home office, folks, is kind of a contrarian idea. You go find a family or a group that they invest in projects, but they're not really well known. They're not out in the general public. Did that kind of make sense? And they're not easy to find either.
Well, yeah, there's a number of things that we could get contrary about. And
Yeah.
let's start with Wall Street as an example. Most people are told, and actually most people are forced, to look at only one investment when they talk about investments, and that are publicly traded stocks, which are traded on one of the major exchanges. And this has been pushed by the industry. It's been pushed by employers who have gone into retirement planning, where they match dollars with the employee, so forth and so on. And one of the problems that we have with Wall Street is, if you look at the price for the stocks on Wall Street, one of the best metrics of that is called the PE ratio, or price to earnings ratio. And the PE ratio on a Wall Street stock could be 25, 50, 100, or unlimited, because the company has never made any money. And therefore, there's no earnings for which you to do a ratio between the price to the earnings. And people have been taught since birth that this is where you make your investments. This is all there is to the investment world. And your only choice is to buy a publicly traded stock that's traded on Wall Street. And that's not true. And there are a number of issues with that. One is that Wall Street 20 years ago had 4 times more stocks available for funding or investment than there are today. And in the last 5 to 10 years, that's been halved again. So of all the stocks you could have bought 20 years ago, only 25%. And the impact of that is that it tends to push prices up, because you have all this money coming in to a smaller and smaller pool of companies. And it's pushing up pricing without pushing up value, because these companies did not improve 400% simply by their existence. This is simply a net reflection of the fact we have shrunk the number of options. We have the same or growing amount of money going into smaller options. That's going to push prices up. And that means that the stock market, Wall Street, as we commonly refer to it, is to a large degree an overinflated valuation pricing. I want to be careful with those two terms, just to get started. So when we talk about contrarian investing, contrarian fundraising, one of the first things we'll point out is that maybe you can invest elsewhere other than Wall Street. And instead of having money go through 1, 2, 3, 4, or 5 layers of bureaucrats, businesses, brokers, money managers who are all sticking their hand into the middle and taking out commissions and fees and so forth, you might want to look at direct investments into something that is either more tangible, maybe priced with greater fairness, something that you might believe in more, however you want to go about looking at it. And this is where, in working with small businesses, I'm an advocate for small businesses. I like small businesses because they create 80% of the new jobs. They tend to bring the innovations to market quicker, better, faster. They employ a huge amount of the people in the United States. And I just think that they make for better company. So with that, you have a choice of investing in a business that's not on Wall Street. This can be done in many ways through a private offering, through investment crowdfunding, and so forth. You can invest in something other than a business. You can invest in real estate. You can invest in Bitcoin. We'll talk about that maybe a little later. You can invest in different types of commodities, gold, silver, coal, whatever. And as of yesterday, apparently we may have a chance to invest in the Panama Canal again, but we'll see where that goes to. So, Eric, what's your thoughts about not investing in Wall Street?
I think that if you're a young investor and you have what I would call a little bit of disposable income, investing in small business is a great concept. And that was the whole, as you know, we're very well, Carl, because you and I have been around it for quite some time. That was really the big push for crowdfunding, the ability to get to small businesses, get them a kickstart with reasonable cost of funds and you're talking about reasonable valuations for a company so that they can have a reasonable return. In fact, I think that there was an article written, last year or year before last, in England. They do more crowdfunding than anywhere else in the world, and it's been highly successful, not only for the businesses, but for the investors. So you can get into some of these things, Carl, relatively inexpensively, right? You don't have to have, unlike buying, say, 100 shares of NVIDIA, which is the big deal, which is what is the PE ratio of that? So the price to earnings, it's off the charts, right? So when you talk about that the PE ratio, what it really says is the value that you're willing to pay for an extended period of time. So if the PE ratio is 10, that means that you're willing to wait 10 years to get your dollar back. Well, some of these PE ratios now are 50, 100 to 1. So you put in $1, you're willing to wait 100 years to get your $1 back. That's insanity. Versus in some of the crowdfunding operations, still there's a lot of risk, but there's a lot of risk in Wall Street. So by picking things that you understand, picking things that you like or use or are going to use, you increase your chances. But you're probably at a PE ratio, in most cases, Carl, when you do something like that, you try to make a business case, and it's probably somewhere around 5. Isn't that really close? Well, that means
when you work with the business appraisers, the people who have experience in buying, selling small businesses, they usually will use a ratio of 3 to 5 times the earnings of the company, which, as you described, it means if you bought it today and the earnings did not grow over time, they stayed the same, it's a plateaued or mature company, it's going to take you 3 to 5 years to get your money back. It's then going to take you 6, 7 years to make a return on your investment. And that's a very common PE ratio for a small business. If it's a growth company, one that has the ability to keep getting bigger every year, then the PE ratio can go up because you're anticipating greater earnings in the future than they are today. And that's where you'll start seeing them get into the 7, 8, 9, 10, 11, 12 PE ratio. But for some reason, once they flip over to Wall Street, then 25 PE starts being like the minimum. And you're going, well, just because they're listed on Wall Street really has nothing to do with the operation of the business, its products, its services, how it performs. But we have this kind of celebrity status that we attribute to a business just because it got publicly registered. And we start to forget or ignore that the true value of a company is based upon how well it's satisfying its customers. Another myth or problem that we have in the investment world is that most investors assume that their investment will always go up.
Yeah.
Despite the fact that historically, forever, investments have gone up and down forever and will continue to go up and down forever, the people who buy into investments want it to go up, but wanting and it happening are two different things. But there's an old joke that each person in a trade of stock thinks they got the better part of the bargain. It's a challenge from contrarian thinking to ask the question, is this company performing well? Is the hype in the market driving the price up when there's no change in value? And is the price likely to come down? And if it is, then we're into what's called market timing and other attempts to second guess the roller coaster of the marketplace. So what's your thoughts on investing at a particular point in time?
So I am a contrarian completely when it comes to the thought process, the market always goes up. And I also am a buy and hold forever kind of guy. But that doesn't mean that I'm expecting that everything goes up indefinitely. What it means is that you can use tools provided by Wall Street to protect your investment. For instance, right now, you can use tools, mainly options, and you can guarantee yourself about a 12% return, positive return. But the big thing is people forget that they need to protect against loss. Loss is the big deal. You could go get your 12% return cash on cash, right? But what if the market goes down 30%? Well, that didn't do you a whole lot of good because you still lost 20%. So there's mechanisms to which what you can do is protect your investments, make the guaranteed 10%, and protect yourself against a 20% drop. So even if the market drops 20% or 30%, you actually have the same value in your portfolio. And that's my thought process. Everyone always, you're right. Everybody always says, oh, this stock is going to go to 100 from 25. Well, what if it goes to 12? It still might be a great company, but it probably is going to go to 12. So buy the stock if you really love it, but protect yourself to the downside. That's a very contrarian idea, to protect against loss. But if you look at some of the great investors of all time, they're willing to take a tiny bit of profit. They're happy as hell to get 8% per year compounded. but they always protect against loss. And so that would be something that I think people need to put in the back of their pocket of saying, okay, it isn't always up. So that's important.
Yeah, there's a big difference between investing for the short term and investing for the long term. When the opportunity zone tax benefit was made available, you have to invest in a property or a business for 10 years in order to realize that particular benefit. And when I looked into it, I found almost no one except for pension funds and insurance companies make investments of 10 years or more. It was almost like it was reserved to them because no one else was thinking that long term. And when you invest in the long term, your intent is to straddle the ups and downs, the roller coaster. So
Right.
you're not going to have the peaks and you're not going to have the lows. But as you described it, Eric, you're happy with a particular rate of return, which is not fantastic. It's not something like a VC or angel investor is looking for, but it's something that's going to make you grow over time. And part of the problem with getting into Wall Street and the roller coaster is that as you near retirement, if all your money's in Wall Street, and Wall Street decides that it's time to go down into a bear market, you may find that your planned retirement isn't going to work. Another example was I had a guest on my show talking about Bitcoin a few weeks ago, and Bitcoin has gone up on average 40% a year for the last 4 years. What was left out of that statement was that about every 4 years, Bitcoin does a major price correction and the investors lose money seriously every 4 years. It's almost a pattern that is predictable. And for those who are paying attention, the next year in that cycle is 2025. So keep that in mind for those who are out there. Now, everything we say in this show is not investment advice. And even if it was, you shouldn't follow it because we can only make general statements based on our opinions, based upon too much time working in raising funding, which admittedly gives us a very cynical viewpoint on the whole capital industry and all the issues of raising money. But it's our opinion based on who we are, where we are, and it's not your opinion, and you have to form your own opinion about what you do. So one of the other contrarian things that I believe in is I think everybody should develop a level of financial literacy that goes beyond balancing your checkbook. Now, I say this carefully because last year, they do a study every year, the financial literacy in the United States, and over half of the adults in the United States did not pass a very, very basic financial literacy test, which is a little bit more than balancing your checkbook. It does include very, very simple investment models, but nothing complex, nothing of any extraordinary amount. And it would benefit everybody who buys anything more than $100 in value to treat every purchase that you make in 2025 as an investment. Whether you're going to buy a subscription to YouTube or the Apple channel, or you're going to buy stocks in a local business, or you're going to put money into Wall Street or anything else. These are all expenditures of your time from which you should get a benefit. And it would be good for you to go through a simple analysis of, are you getting more from this over time? Are you simply consuming it like buying food where there is no return? What are you doing with your money? And which of these constitute true investments, whether it be your house, your car, your stock portfolio, or a piece of real estate? Give some thought to that and ask yourself where you might get to learn more and help yourself understand more options, more things you can do, and go that route. But since the crash of 1929, which I keep telling people I was not here then, I'm not quite that old, the government assumed that people, by and large, were not competent to manage their own investments. And they passed a bunch of laws, starting with the 1933 Securities Act, and added rules and regulations ever since then that, by and large, said that unless you're rich, as we define it today, you shouldn't be making investments on your own. You should go out and get some help. You should hire an investment advisor, engage a broker, get somebody who is regulated and restricted by the government what they say and do. And not against that. Good advice is good advice wherever you get it. Like any purchase of services, you should determine if it's a good value for what you're getting and it's of the quality that you want to pay for. But I think people are much more sophisticated, much more capable today of making investments. And I think that they should take a bigger hand in whatever investment they're in, even if it's an employer-based contribution to your retirement plan. Do you have choices in which funds you go into? Do you understand why you choose one fund over another? Is it an index versus a stock grouping? These are all things that are important to you, and it's good for everybody to do that. But today we managed to get crowdfunding, investment crowdfunding passed in 2012, which allows you to invest in local businesses. So you have a much broader suite of potential investments to choose from. We have other laws which allow you to invest into real estate directly or through a holding company, such as a REIT. And it would be good for you, as they say, to have a diversified portfolio that allows you to look at all these different things, consider the short and long-term hold required to receive benefit from it, and think about it more. Get some advice, get some assistance, take some courses, and improve your skill and capability in 2025. So, Eric, are you investing in Bitcoin?
No. If I could find the appropriate tool, and I think I can, I would probably, what I would do, not even probably, what I would do is put in a financial instrument so that I could profit off Bitcoin going down. That would be my, and I would also add to that, the financial instrument would have to be able to give me a little bit of a return if in fact it went up. That would be my preference. I don't go out on a limb here. Bitcoin to me is pure fluff and mystery. When you, and people would say that about fiat currencies like the US dollar, right? The difference is you can value the US dollar based on its ability to protect the country, i.e. military tanks and ships and stuff. Bitcoin, I don't get it. I just don't get it. I don't understand why it has any value whatsoever in the real world. What can you do with it? What does it protect? What does it do? I mean, therefore I can't get my arms around that.
Well, and this is as I tell my clients and instruct students when I teach, Bitcoin has no true value. There is no underlying basis for assigning anything to it. It is essentially, you call it fluff, but it's a market expectation which may or may not survive. And so when people go, well, hey, you should get into Bitcoin, it goes up. I go, does it go up all the time? Does it ever go down? Because if the expectation changes, somebody decides that they are not comfortable with it, you lose what is called consumer confidence, it can go down. And since it has no value, it can go down to zero. And And so me being me, I'm going like, why would I buy Bitcoin? Why would I invest in something that is completely dependent upon a bunch of people thinking that it should have a higher price without understanding it can have a lower price? It's not something that makes a lot of sense to me. I have some friends in Bitcoin. I know a lot of people behind Bitcoin that get into it, but when they tell me how great Bitcoin is, they all are telling me that because it's gone up more than it's gone down, that it's good. And I'm going, that's not enough of an excuse for me to consider making an investment. So as a contrarian, I look at all the cryptocurrencies. There are some that are backed by tangible value. They represent maybe the digital representation of the assets of a company. It may be an actual physical asset, such as commodity. That's totally different because they're backed by value. And as you would expect, if the value of those items go up because the company performs well or a particular commodity goes up on the world market, then you could expect a price increase. But when you expect a price increase simply because you want a price increase, it's not necessarily a great way to start.
So,
Yeah,
so what I would add to that is when you look at most cryptocurrencies or many cryptocurrencies, the real reason they have, quote, value has nothing to do with the coin. What it has to do with an old school idea of technical analysis and trading algorithms. So the value is perceived in the algorithm. If the algorithm is saying it's giving you a buy signal, then that's why people buy it, because there's buy signal. And that, so, but that isn't value as you and I would determine it. That's just using, in some cases, AI, right, to figure out how come there's more buyers than sellers, which may have nothing to do with anything other than a computer program saying, wow, this looks like an opportunity, because technically in the movement, it's a buy. But technically, in my world, it still has no value. Did that?
Yeah, but this is what I talk about public perception. If they all think it's going to go up, then
Right.
they all buy it. And if they all buy it, then it goes up. There was a famous penny stock company based here in Denver back in the early 80s who, amongst their many nefarious practices, they had brokerage offices on both the east and west coast of the United States. And when they brought out a new issue of a penny stock, they would tell the brokers on one coast, tell all your clients to buy this stuff. And the ones on the west coast, the other coast, they'd say, wait and see if this is going to go up or not. If it goes up, then maybe you should get in on it. And so on week number one coast is selling, the other is waiting. And then the next week, they reverse it. And the ones on the other coast said, well, look, it went up. You should get in now before it goes up more, and tell the other ones to sell because they've already, take your profits and get out. And they would seesaw the stock up over a period of weeks until everybody realized there's no way this company could, achieve anything that looked like the PE ratio would, as you described it, Eric, would get up in the hundreds. And you're like, okay, that's not real. All we're doing is dealing with speculators who have talked each other into doing something. So what is the true value? Something for consideration. That's a contrarian thought for all investors everywhere. Check the value first before you buy into the price. So other things that are contrarian, what else is on your mind, Eric, that people do or shouldn't do, or the capital market does that doesn't make any sense?
There's a lot of things about the capital market that doesn't make sense. Let's start with the thought process. We'll pick on the venture capital guys because they're easy, like BlackRock. Okay. giant, giant firm, billions of dollars under management, and they have this ability to throw hundreds of millions of dollars at a project, and if they lose, whatever. So I'll give you an example. There's been a lot of discussion about airstripping. So you have this device and you put it on your house, and it'll strip the water out of the air and give you, quote, clean drinking water for your house. Well, there's billions of not billions, but there's many hundreds of millions that have been spent trying to do this. And as a young person said to me the other day, they said the management of this company was all, wow, we have just invented something that not even Google could do. Well, that's a pretty big red flag, right? People were investing like crazy in this technology because it would change the world. And this young person said to me, if Google can't do it, what do they think a couple of backyard mechanics can do that they can't do when Google already spent $1 billion or whatever it was trying to invent it? So sometimes you have to think it through and go, in a contrarian manner, is it realistic? Can this really happen with those resources? And forget about the crowd, right? Because the crowd is if you follow the crowd, you might make it a little bit in your investment. But if you think a little bit contrarian and look at the crowd and go, wow, the crowd's all excited about this. Should I be as excited as the crowd? Going back to what you're talking about, is the underlying value. And I want to, if I'm raising money for my company, how do I get the crowd to understand I have value versus chasing the rabbit? And that's really a big thing. And understand that it's stacked against you, right, Carl? So you can't, as a small company or as a investor, right? If you're not an accredited investor, and this is one of mine and yours big peeves, right? A lot of the tools are you can't use them, right? So for a non-accredited investor, he goes invests in Wall Street, but he can't use contrarian ideas to protect his portfolio, right? Because options trading is only for accredited investors. Well, how can you protect your portfolio if, and this goes for you raising money also, how can you protect your fundraising effort if you can't get to the quote people who have been authorized to invest, which gets you back to your crowdfunding, where it is a contrarian idea, but you still have to, as you've mentioned before, you still got to get a crowd. Well, how do you get the crowd? But you know where I'm headed with this.
Yeah, what the capital industry did was it took the position that a wealthy person had, open field running to do whatever they wanted to do and make an investment, but everybody else has to conform to all these rules, limits on what they can buy, where they can buy, what they can do to hedge their investment. All these things are not tools that are available to the ordinary person. And as a consequence, we're still dealing with what I call after effects or artifacts of wealthy investing styles and issues. There's a number of things I go off on here that the investment model for angel investing, which is a wealthy person putting their individual money at risk instead of managed money on behalf of somebody else, they still want a high rate of return. And we have a problem with that when 60 to 70% of the small businesses in the United States don't make a profit of more than 10% a year. So how are they going to pay a high rate of return to an investor when they have essentially a limited or capped profit margin to work with. And this goes further, and this is another one of the points where I'm totally contrarian, is that a lot of people, I would say almost everybody who's trying to take advantage of investment crowdfunding, which was intended to make investment available to any adult in the United States, is they come to the person and they style and craft their offer as though they were making a pitch to an angel investor. Hey, look at my stuff. Now, ordinarily, I would tell you you're going to get rich and we're going to do great, but I'm asking you for $100 and an investment. Now, you have to stop and ask yourself two questions at this point. If they only invest $100 and the stock goes up 10 times, which would be a fabulous increase in value, how much money are they going to make? Well, they're going to make $1,000. Well, that's not going to put their kid through college or buy a new car or anything. So when you're telling people they're going to get wealthy $100 at a time, it's going to be difficult to get there. Now, some people like Devin Thorpe are advocating, I agree with his approach, $100 a month throughout your entire career, your entire life, you can build up a savings account of investments in different businesses. And if you pick and choose them carefully, you may end up with a rate of return that's better than Wall Street. But if you tell a person they're going to get wealthy with a single $100 investment, I think that you're off counter. The other thing that is troublesome to me is that an angel investor is making investment not out of the money that goes into their house, not out of the money that they pay the utilities bill, not out of the food that they put on the table. They have money setting to the side for the purpose of making investments. That's why they're wealthy. They have discretionary money to invest. The average person has money maybe to pay the utilities, to put food on the table, to keep a roof over their head. When you structure a deal in crowdfunding to the average person, you can't, one, assume that they have discretionary money ready to invest, and you can't tell them that they're going to get wealthy with a $100 investment. The whole deal doesn't make any sense. I structure crowdfunding deals so that they're directed to the customers of the business, where the business has a lot more options on how to structure and package a deal to give value to their investors. But if they're not customers, I don't see how you can get there from here. And this is one of my many contrarian thoughts that most people are doing crowdfunding wrong. One, they're appealing to angel investors, and the deals are too small, too uncertain, too risky, so they're not going to qualify. They're not going to win the foot race with all the other investment candidates out there. Structuring them in small amounts means that the investor has to do more work to manage their portfolio. It's if an investor is used to making a $25,000 average investment, asking them to make a $100 investment or even a $1,000 investment means that they have to manage 25 times more companies to get to the same total dollar investment, which becomes its own problem. So, but if you're going to an average person and ask them to make 12 investments a year of $100 each, that's manageable. So that makes more sense. But we keep trying to force people in crowdfunding to do deals as though they're going to get rich, as though they're going to be equivalent or competitive with deals that angel investors and private equity firms and even family offices are looking at. And that just doesn't make any sense. It's a different game with different rules, with different values and different pocketbooks. So we need to play a different type of game. Other things in the capital industry, I'll give you another chance. Pick one of the many things that somehow drives you crazy.
Another thing out there. Okay, so the other one would be real estate. And we have an example right here across the street. So 10 years ago, the house sold for $225,000. That house now today is trying to be sold for $525,000. So the previous owner, it's back to what you were talking about earlier. They bought the house, they stayed in it a year. Their expectation was that they were going to get a windfall profit. And that simply isn't the case. Just because there's a housing shortage doesn't mean that the housing prices can continue to go up. So what you have to look, you don't have to, but when you're looking at buying, right, people have gotten retrained, like you're saying, to think that they can buy a home and it will always go up in value. No, you buy a home because it's a place you're going to live with a roof over your head. That's why you buy a home. This concept of, and it's not necessarily Wall Street, but certainly of the finance industry is, oh, you buy a home because that home becomes your retirement later in life. What a crock. Your home is a place you live that you enjoy. Now, has that been true for some people over the last, I don't know, probably 30 years? Probably so. But if you think about that, and if things have changed, obviously, but from a contrarian standpoint, if you could have found a reasonable rent, and the difference between buying, right, and the difference of rent, let's say that was $1,000 a month, just for shits and giggles, and you took that $1,000 a month and you were to invest it, whether it's in crowdfunding or whatever, how much more money would have you had? A lot.
Right. Well, in let's go down this path a little bit more. The story used to be that you got a tax break because the interest that you paid on the mortgage on your house was fully deductible. And so when you itemized your deductions, this was like the big deal for reducing your tax liability. And then a few years ago, they changed the tax laws by raising the level of your amount of your deductible expenses so high that it became very difficult for you to recognize any interest payment on your house as a deductible because you're already covered under a standard deduction. This happened in our household. And at that point, the whole magic of, oh, look, the house is appreciating, but at the same time, you're getting a tax deduction on it, that combination disappeared. And so as you framed it, Eric, your house is an investment, but how much of an investment is it? What kind of return are you going to get? This is another thing that even though we've seen housing prices go up dramatically, and there's question if and when they're going to come back to a lower level, are you getting a great rate of return if you view it purely as an investment? And if a house doubles in value over 20 years, that's 100% divided by 20. That's what, 4%, 2.5% rate of return, or something like that, 5% rate of return. So calculate it out. It's something that you need to look at. Anything that's, as I said, if you're going to spend $100 or more in 2025, stop and ask yourself, is this an investment? Is this something that's going to maintain value or increase in value? Is it something that may maintain price or increase in price? If it doesn't, then it's a consumable and you're going to have to put it in this bucket over here. Similarly, if you're out raising funding and you know that your business is going to have trouble attracting investment because investors are putting all their money into Bitcoin, why would they invest in a small business with a 5, 6, 8, 10% ROI potential per year when they can get 4 times that in a Bitcoin investment? This is one of my biggest complaints about Bitcoin is the indirect consequence that it's sucking money out of the investment market, out of the capital market, away from small business startups, away from innovations. It's all going into a ethereal type of investment, which could crash this next year. And where does that leave everybody? Somebody took the money out, somebody sold it, somebody made a profit, and somebody didn't. And this is kind of getting into a question of is it going up or going down? Because one's a win, one's a loss. And can you afford the loss? Whereas if you invest in something that has true value, it may go down, but usually it only goes down a little, not a lot. And then it may start increasing in value over time for one reason or another. So these are a variety of contrarian thinking out there, because it doesn't always go up. Wall Street's not always better. Stock is not necessarily better than something else. Owning your own house is not something I disagree with, but I want to approach it with a thought process, with an assessment, with my thinking hat on, and not simply assume that, again, everything goes up. Eric, any last thoughts before we call it early today? What contrarian thoughts would you like to share before the Christmas holiday?
Not really. I think we've covered a lot. I think, well, maybe the last thought is this. Thinking like a contrarian is not popular, okay? In fact, it's incredibly unpopular. But if you think like a contrarian, in other words, you don't follow the pack, right? Your chances of raising money for your project greatly increase, because you're going to be a little bit different. You're going to act differently. You're going to present your product differently. If you want to go down, and let's talk about crowdfunding, for instance. The biggest problem with crowdfunding is getting the crowd, right? So your idea of, if you don't already have a crowd, you can't really do effective crowdfunding.
Right.
But people continue to try to follow the old school, right? And they continue to go to they think like, right, they think about the accredited investor. Look at all of the crowdfunding platforms out there. There's almost none that actually are crowdfunding in the terms what you and I are talking about. They're all set up for accredited investors. And so that immediately, you just threw out 90% of your possible group that you could get money from. So from a contrarian standpoint, stop. If you're a small business, stop going down that road. Don't even bother, right? Especially if you think that you're going to do, let's just say you're a window shop, for instance. So you're a little window shop. And your little window shop, you do a net profit every year. Let's say you're really good and you do net of 25 to 30,000 a year. Well, you need to raise 100,000 so that you can get that profit up to 100,000 a year. It's all bullshit, but let's just say that's the case. Maybe what you ought to be doing is saying, I'm willing to get $100,000 from every $100 person out there. But what you need to start thinking it through, what am I willing to give back to that group that makes sense for me to get to my bigger capital raise, or my bigger capital stack, however you want to put it. And I don't think I don't believe that they think like that. I think that a lot of crowdfunding people, they think that because someone invested their $100, And you're right. They think that they're going to get rich. They're going to get 10 times or whatever, 20 times, rather than going, you know what? Think a little differently and say, okay, I got a window shop. Well, maybe what I really do is I give back a tiny bit to them over a long period of time. And maybe over the year, instead of giving them back their $100, maybe you couldn't do it with $100, but maybe they get a window, but they get a free window if they buy 10 windows. Do you see what I'm saying?
Yeah, no, that's totally what I agree with. That if they're a customer, you have the margin in your products and services that you can give up a portion of that to achieve a higher rate of return. And you can create packages where the value is guaranteed as opposed to speculative. And it's a totally different deal. But we're out of time for today. It's time to go celebrate Christmas. This is my CAP AI avatar. If you use the QR code, you can go to my website, ask CAP questions throughout the holidays, because he'll always be on duty throughout every day. And then in addition to that, as I said, is if you're interested in my workshop, go to my website, get more information, read my newsletter, watch this video, and take down this address because the discount code is good till the end of the year. I invite you all to consider improving your skills and knowledge and raising funding, and I'm here to help. So thank you, Eric, for being with us today on this discussion of contrarianism in the capital industry. And thank you to our audience. Take care, everyone.
Thanks, Carl.